Welcome. This is going to be a video tutorial going over the problem E10-14 from the Pearson textbook, and it's about amortization in the exchange of assets. So we have Triad Freight. They're a large warehousing and distribution company that operates throughout Eastern Canada. They use the units of production method of amortizing their assets. So that is important for us to know, the units of production method. They believe that this best matches the wear and tear on their trucks, and that's probably true of vehicles in general. They trade in used trucks often to keep driver morale high and to maximize fuel efficiency, and consider these facts about Mack truck in the company's fleet. Okay, so really, this is a pretty large opening paragraph. What we need to glean from this, or what we need to take away, is that they use the units of production method. That's really all we're likely to need in this problem. When they acquired the truck, and I'm over here now, the tractor slash trailer cost $585,000. So we have a historical cost of $585,000. And it was expected to remain in service for 8 years or 1,500,000 kilometers. So with units of production method, we measure the unit useful life in units. So I'm going to highlight that down here of 1,500,000 kilometers. Okay, estimated residual value is 60,000. So I'm going to highlight that. We're going to need that as well. The truck was driven in year 2014, 150,000 kilometers. And maybe just to make this a little bit easier for all of us, what I'll do in 2014, it was driven for 150,000 kilometers. In 2018, it was driven 150 in 2014, and then I guess it wasn't driven until 2018. That seems odd to me, but that's okay. 195,000 kilometers. Oops, 195. And 235,000 kilometers in 2019. 2019, 235, 123. Okay. After 100,000 kilometers in 2020, so it was driven 100,000 kilometers in 2020 as well. Wow. Interesting problem. All right, so it looks like they bought it originally in 2014, and then they drove it a bit, but then they didn't drive it in 2015, 16, or 17. So that means if they're not driving it in 2015, 16, or 17, because they use a units of production method, they are not going to recognize amortization against it. So that's what this problem, I think, is trying to get us to recognize, that yes, they've used it, they've owned it for multiple periods of time, but because they only have driven it these years, we're only going to recognize amortization expense in the years that it was driven. Okay, so let's see what happens next. So after it drove that 100,000 kilometers in 2020, they decided to trade in this truck for a new truck with a market value of 510,000. All right, on August 15th. They did that with a trade-in, but they also paid cash. So they paid for this in a combination through cash and in exchange of assets. What we need to do now is to determine or prepare the journal entry to record the trade-in. All right, simple enough. So what do we have to do here? Well, in doing the journal entry for an exchange of asset or asset disposal in general, there's always 3 things we need to do. And to solve this problem, I'm going to do it 2 ways. First, I'm going to do the shortcut. Second, I'm going to do it the long way. Okay. So my shortcut way here is just to recognize what is easy about this. All right. The easy thing about this is that we know it's on August 15th. We know the date of the journal entry. We know that they're getting a new truck, right? So I'm going to debit a new truck. And I can always reference, if I forget, my cheat sheet, my DC Adler. I know a truck is an asset. So to increase an asset, I'm going to debit an asset. And that's what we see here. To increase an asset, I debit an asset account. Okay, so I'm getting a new truck, and I'm going to recognize that new truck at its market value on the date of acquisition, which is 510,000. That is what is easy. Additionally, what is easy is recognizing what we gave up. What we gave up is, well, cash, right? We paid for this in a combination of cash. That cash was $40,000. The problem told us that. And probably this would be easier to read if I erased this markup and just highlighted the markup I was working on. Triad paid cash of 40,000. But it also traded in, right? It traded in the Mack truck that it currently had. So we need to remove from our balance sheet the old truck, right? The old truck or the Mack truck or whatever you want to call it. So here we know that historical cost on that old truck was $585,000. We're going to lower that with a credit, right? To increase assets, we debit assets. To decrease it, we do the opposite, which is a credit. Okay. But we need to remove that old asset entirely from our balance sheet, which means we need to also remove the accumulated amortization on that truck. And I should say old. And I know I should be consistent with the convention of these account titles. So let me just adjust that one so that it's the same. Okay, we need to remove it. We need to remove it with a debit. We just need to calculate now what accumulated amortization is. Now they use the units of production method. To use the units of production method, what we need to do is determine a rate, a per kilometer rate. That per kilometer rate is going to be equal to its historical cost minus residual value. So historical cost minus residual value divided by its useful life in units. So this is going to be the rate that we're going to multiply by. Okay, so we know its historical cost is, and I think I highlighted this just above. I did, and I'm just going to scroll to the right. Bear with me, folks. Historical cost is 585,000. Its residual value is 60,000. And I summarized this at the beginning. And its useful life in units is that 1.5 million kilometers. This gives us a rate per kilometer, how much it depreciates every kilometer it's driven. And I'm not even going to attempt to do that calculation in my head. So 585,000, subtract the residual value of 60,000 divided by that 1.5 million kilometers. So 35 cents per unit. So rate is that 35 cents per kilometer driven is the amount that we're going to amortize per kilometer. And we were given the kilometers driven, if we recall from the question, right? Each year we were given the kilometers that were driven. And I summarized that as I read the problem. So let's just go back and verify. It told us the truck was driven 150 kilometers in 2014, 195 in 2018, and so on. I summarized that for us here. So to determine the annual amortization, or the amortization at least for the years that we were given, is simply going to be the number of kilometers that it was driven multiplied by the rate, the per kilometer rate. So I'm going to multiply these two together. 150 multiplied by that rate is 52,500 in 2014, 68, 82, and then 35. This means that the accumulated amortization is going to be the sum of all of that. So if I were to add all of this up, and I will do that, I'm just going to insert a row, and it's going to stretch my markup a little bit, and my apologies about that. This is my per year amortization. The accumulated amortization is the sum of all of this. The accumulated amortization, of course, is a permanent account on the balance sheet. Okay, so if we're removing this old truck, the asset cost, we also need to remove its accumulated amortization. We're going to do that with a debit. We debit accumulated amortization to decrease it. We reduce it to 0. So we're almost all done here with the shortcut method. There's a problem that I hope you're recognizing. I'm going to add up all of my debits and all of my credits. And right now we can tell that they are not equal. My debits are in fact greater than my credits. So I'm missing something. I need there to be a credit of 123,000 to bring my journal entry into balance. So I need to credit something by 123,000. I hope everybody recognized that. That credit needs to be this gain on exchange of trucks. Right? We experienced a gain on this, so I credit my gain. That brings my journal entry into balance. This is the shortcut method of doing this, by just focusing on the journal entry and focusing what is easy. Now you can always verify this, and I'm going to copy and paste this tab. I'm going to create a new copy, and I'm going to erase some of the stuff that I did here. We're going to need these amounts, of course, but the long way of doing this problem is recognition that step one is to bring amortization up to date. So we need amortization up to date so that we can calculate net book value. Now we calculated accumulated amortization here. So I'll just specifically identify accumulated amortization and make it as clear as possible by putting a little arrow next to it. So we did step 1 in the prior step. Step 2 is to calculate a gain or a loss. And I'm gonna scroll down and I'm gonna show you a template in which you can do that. Now, to calculate a gain or a loss, it's generally always selling price minus net book value. That's going to equal a gain or a loss. And it's a gain if it's positive, and it's a loss if it's negative. This question is complicated in that we're dealing with an exchange of assets. So how do we know what the selling price is? Right? How do I know that? We can force this selling price by doing what we know. What we know is we paid cash of $40,000. We paid cash of $40,000, and we know we acquired a truck worth $510,000. So bear with me here. So if I bought a truck of $510,000, but I only paid $40,000, where did the rest of it come from? The rest of it came from selling your truck, the trade-in value of that truck. So 510,000 minus that $40,000 in cash, this is going to be equal to 470,000. This is the trade-in value that you got for your truck, $470,000. So I'm going to put that as my selling price here. I'm going to calculate what net book value is. We did this on the prior screen, but net book value, of course, is historical cost minus accumulated amortization. So here we have historical cost of this truck we traded in was $585,000. Accumulated amortization we calculated at $238,000. And I'm not even going to attempt that in my head. So 585 minus 238, whoops, minus 238. It's going to give us 347,000. That's the net book value. 347, 1, 2, 3. And then the difference between these two, which is, what is that, 123,000. This number is positive, which means it's a gain. Okay. And then step 3 is to do the journal entry for the disposal, which we've already done. I did because I copied and pasted it out. But let's just see, does it confirm? I did my gain on exchange was 123,000. That exactly matches this calculation I did down here, okay? So the shortcut or the long way will work for you. Depends on what makes it easier or what's easier in your head. It's best practice to probably do both to make sure that it matches, okay? So this was E10-14 from the Pearson text. If you have any questions, feel free to reach out. Otherwise, take care.